Welcome to the Contrarian Compass. We are diving deep into an important metric that every investor and financial analyst should understand. Return on Capital Employed, or ROCE. Whether you're just beginning to learn about finance or you're already an experienced investor, understanding ROCE can give you valuable insights into how efficiently a company uses its capital to generate profits. Throughout this video, we will discuss the fundamentals, provide real-world examples, and show you how to interpret ROCE effectively. We'll also cover its limitations and practical applications for both investors and companies. So let's get started. What is ROCE? ROCE stands for Return on Capital Employed, and it's a key profitability ratio that measures how efficiently a company generates profits from the capital it employs in its business. Simply put, ROCE helps determine how effectively the funds, both equity and debt, invested in the company are being used to generate profits. The formula for calculating ROCE is straightforward. ROCE is equal to earnings before interest and taxes, also called EBIT, divided by the capital employed. EBIT represents the operating profit of the company, while capital employed is the total amount of capital invested in the business. ROCE is widely regarded as one of the most important profitability ratios because it provides a clear indication of how well a company is using its resources. Now let's look at the formula for ROCE in detail, and let's break that formula down to understand it better. Earnings before interest and taxes, EBIT. This is the company's profit before interest and taxes are deducted. EBIT is also known as operating income or operating profit because it represents profit from core operations without the influence of financial and tax expenses. This gives a clearer picture of how well the company is performing from its core business activities. Capital employed. This is the total capital used to run the company. It can be calculated in a few different ways, but a common method is total assets minus current liabilities. This tells us how much capital is being actively employed in the business after accounting for the company's short-term obligations. In simple terms, capital employed is the sum of shareholders' equity and long-term liabilities. Another way to think about capital employed is that it represents all the resources used to generate profits, both the money invested by shareholders and the funds borrowed through loans. This combination of equity and debt provides a more complete picture of how the business is funded and how well it's using those funds to make money. Now, why is ROCE such an important metric? ROCE is a powerful tool for understanding how effectively a company is using its capital to create profits. Unlike some other profitability ratios that only consider equity or assets, ROCE takes into account both equity and long-term debt. This makes it particularly useful for investors who want to gauge a company's long-term performance and sustainability. For example, if two companies have similar profits, but one has a slightly higher ROCE, it suggests that the company with the higher ROCE is utilizing its capital more efficiently. It's a key metric for comparing companies within the same industry to identify those that are generating better returns for their investors. ROCE also helps highlight whether a company is generating enough returns to justify the investments made by shareholders and creditors. For example, if a company has a low ROCE, it could indicate inefficiencies in operations or that capital is not being employed effectively to generate returns. Let's walk through a real-world example to understand how ROCE works. Imagine a company called TechGear Solutions. Here are some of the financial details. EBIT, that's earnings before interest and taxes, $200,000. Total assets, $1 million. And current liabilities, $200,000. First, we need to calculate the capital employed. Now, as we know, capital employed is equal to total assets minus current liabilities, which is $1 million minus $200,000. That's $800,000. That's your total capital employed. Now we calculate the ROCE. ROCE is equal to EBIT by capital employed, that is $200,000 divided by $800,000. That calculates to 25%. This means that for every dollar invested in the business, TechGear Solutions generates 25 cents in profit before interest and taxes. ROCE of 25% indicates that the company is quite efficient at utilizing its capital to generate returns. Let's consider another example. RetailPlus Inc. has an EBIT of $500,000, total assets of $3 million, and current liabilities of $500,000. To calculate the capital employed, once again, capital employed is equal to total assets minus current liabilities is equal to $3 million minus $500,000, that is $2,500,000. So the ROCE is EBIT divided by capital employed is equal to $500,000 divided by $2.5 million, which calculates to 20%. This means that the ROCE of 20% for RetailPlus Inc. Is generating 20 cents of profit for every dollar of capital employed. By comparing these two examples, we can see how companies with different levels of capital employed use their resources to generate returns. Now let's take a closer look at capital employed. The concept of capital employed is crucial because it represents the total capital that is actively being used in a company's operations. This includes both equity, the money invested by shareholders, and long-term debt, the borrowed funds the company uses to expand its operations. For industries that require significant capital investments, such as manufacturing, utilities, or telecommunications, capital employed often includes substantial amounts tied up in physical assets like machinery, buildings, and infrastructure. ROCE can help investors understand if these investments are being effectively used to generate returns. For example, consider a utility company that has invested heavily in infrastructure. A high ROCE would indicate that the company is making efficient use of its power plants and distribution and its distribution networks to generate profits. Let's take another example. Consider a manufacturing company, XYZ Manufacturing, which has invested $5 million in equipment and facilities. Suppose its EBIT is $750,000 and its current liabilities are $500,000. The capital employed here would be $5 million minus $500,000 is equal to $450,000. The ROCE would be $750,000 divided by $4,500,000. That is 16.67%. This ROCE indicates how well XYZ Manufacturing is using its capital to create returns from its operations. For companies that are more capital intensive, such as those in mining or oil and gas, significant investments are required to acquire and maintain physical assets. In such cases, a high ROCE is a sign that the company is using these assets effectively, whereas a low ROCE may suggest underutilization of capital or inefficiencies in asset management. How does ROCE compare to other financial ratios like ROE, that's return on equity, and ROA, return on assets? Return on equity measures the profitability relative to shareholders' equity. It only considers the equity part of the capital structure, which means it's focused on how much profit is generated for shareholders. On the other hand, return on assets measures profitability relative to total assets. It provides insights on how efficiently the company is using its assets to generate profit, but it doesn't consider how those assets are financed. ROCE is different because it takes into account both debt and equity, providing a more comprehensive view of how effectively the company's total capital is being utilized. For example, a company might have a high return on equity but a low return on capital employed, indicating that although it's generating good returns for its shareholders, it might not be efficiently using its total capital base, especially if it has significant debt. Let's consider two companies, Alpha Corp and Beta Inc. Alpha Corp has a return on equity of 20% and a return on capital employed of 15%, while Beta Inc. has a return on equity of 12% and a return on capital employed of 18%. This means that although Alpha Corp is providing good returns to its shareholders, Beta Inc. is using its overall capital more efficiently. Another way to compare these metrics is by looking at company C, another fictional company, which has significant debt on its balance sheet. Its return on equity might be high due to leveraged returns, but its return on capital employed should be lower because of the higher capital employed. This scenario shows the value of ROCE in assessing the efficiency of the entire capital base, not just equity. So what constitutes a good ROCE? Generally, a higher ROCE is better because it indicates that the company is generating more profit per dollar of capital employed. As a rule of thumb, an ROCE higher than the industry average and above the company's cost of capital is considered good. This means the company is generating value and using its capital effectively. For instance, if a company has an ROCE of 15% and the cost of capital, which is the cost of debt and equity financing, is 10%, it's creating value because it earns more than it costs to finance the capital. However, it's important to compare ROCE within the same industry. Different industries have different capital requirements, and comparing a tech industry to a utility company might not provide useful insights. For example, tech companies which are less capital intensive often have a much higher return on capital employed compared to utility companies that have a lot of capital tied up in infrastructure. Let's take another example from the retail industry. Suppose retailer A has a return on capital of 22%, while retailer B has a return on capital of 12%. If the industry average is about 15%, retailer A is outperforming the average and indicates efficient use of its capital to generate profits. A good ROCE is also one that shows consistency over time. If a company's ROCE has been steadily improving or maintaining a high level, it's a good sign of effective management and operational efficiency. On the other hand, a declining ROCE could indicate potential problems such as inefficient use of new investments or rising operational costs. While ROCE is a powerful metric, it also has some limitations that investors should be aware of. One major limitation is its sensitivity to capital structure change. For instance, if a company takes on more debt to finance its growth, the capital employed will increase, which could lead to a decrease in ROCE, even if the additional capital is being used efficiently. Another limitation is that ROCE may not be as useful for companies with significant intangible assets. For example, companies in the technology or pharmaceutical industries invest heavily in research and development, R&D, which is recorded as an expense rather than a capital asset. This can lead to a lower ROCE even though the company might do well. Consider a pharmaceutical company, let's call it Pharma Max, which spends heavily on R&D. This expense doesn't show up as a capital asset, which means that despite making strides in drug development, its ROCE might look artificially low. It's essential to consider such nuances while evaluating companies in sectors with large intangible investments. Also, for fast-growing companies, ROCE can be misleading. These companies may be in a phase where they are heavily investing in growth, and their ROCE may be lower as a result. It's important to consider the company's life cycle stage when interpreting ROCE. For instance, a tech company or a tech startup may have a low ROCE initially because it's investing heavily in infrastructure. It may be investing also in talent and technology. However, as the company matures, its ROCE may improve as these investments start to generate returns. Another limitation of ROCE is its potential distortion due to cyclical fluctuations. Companies operating in cyclical industries may experience significant variations in their return on capital due to changes in economic conditions. For instance, an automobile manufacturer may have a high ROCE during periods of economic boom, but much lower during downturns, reflecting changes in consumer demand. Let's discuss some practical applications of ROCE for investors. For investors, ROCE is a valuable tool for comparing companies in the same industry to identify which ones are using their capital most effectively. For example, if you're looking at two retail companies, let's call them Retail Corp A and Retail Corp B, and Retail Corp A has an ROCE of 18%, while Retail Corp B has 10%. This suggests that Retail Corp A is more efficient in generating returns from its capital base. ROCE can also help investors assess a company's long-term profitability and sustainability. Consistently high return over several years may indicate a company's strong market position and effective use of its resources. Investors may prefer companies with high and stable ROCE as it indicates better value creation for shareholders. Another practical application of ROCE is evaluating whether a company's returns are enough to cover its cost of capital. If a company's ROCE is higher than its cost of capital, it suggests that the company is generating value and using its resources effectively. How can companies improve their ROCE? Companies can improve in their return on capital in several ways. But it's important to remember that while increasing ROCE is a goal, it should be done sustainably. One common way to improve is by optimizing working capital. This means managing inventory more effectively, collecting payments from customers faster, and negotiating better payment terms with suppliers. By reducing the amount of money tied up in working capital, companies can improve their return on capital employed. Another way is by avoiding unnecessary capital expenditure or CapEx. Companies should ensure that investments in new equipment or facilities generate sufficient returns to justify the capital employed. If the expected return from an investment is lower than the current ROCE, it might not be a good use of funds. Improving operational efficiency can also boost ROCE. By cutting costs and improving profit margins, companies can increase their EBIT without increasing capital employed. For example, Auto Parts Co. implemented cost-saving measures that increased its operating profit, which in turn improved its ROCE. Asset divestment is another strategy to improve ROCE by selling off underperforming or non-core assets. Companies can reduce their capital employed and focus on more profitable parts of the business. For example, Globetech, a fictional company, sold a non-core division that had a low ROCE, allowing it to focus on core operations that generated high returns. Lastly, increasing revenue without significant additional capital can also improve the ROCE. This could involve entering new markets, launching new products, or leveraging existing infrastructure to generate more sales without significant new investments. To summarize, ROCE is an important financial metric that helps assess how effectively a company is utilizing its capital to generate profits. It provides insights into the efficiency and profitability of a business, making it a valuable tool for both investors and company management. By comparing ROCE across companies, investors can identify which businesses are making the best use of their capital. However, ROCE also has its limitations. It can be affected by changes in capital structure, may not be as useful to companies with significant intangible assets, and can vary due to economic cycles. It's important to use ROCE alongside other metrics and consider the industry context when interpreting it. For companies, improving ROCE involves optimizing working capital, making smart investments, improving operational efficiency, and focusing on core assets. Sustainable improvement in ROCE can lead to long-term value creation for both shareholders and the company. If you found this video helpful, make sure to like, subscribe, and please hit the notification bell to stay updated with more in-depth analysis of financial metrics and investment strategies. We'd also love to hear your thoughts. Please leave a comment below about which financial metric or metrics you'd like us to cover next. Thanks for watching, and we'll see you soon in the next video.